While the trade-off theory is about finding a perfect balance, the pecking order theory is about convenience and secrets. Proposed by Myers and Makhlouf, this theory suggests that managers don't actually sit around calculating the optimal debt-to-equity ratio. Instead, they choose the path of least resistance, following a strict hierarchy, a pecking order, based on one key problem: asymmetric information. 1. The core problem: managers know more. The fundamental intuition is that managers know more about the company's true value than outside investors do. This creates a signaling problem. The bad signal: if a manager tries to sell new shares, equity, investors might think the manager must believe the stock is currently overpriced and wants to sell it to us before it drops. As a result, the stock price often falls when a new issue is announced. The neutral good signal: if a manager uses their own cash or borrows money, debt, it signals confidence. It shows they believe the company can cover its obligations without needing to trick new investors into buying shares. 2. The hierarchy, the order. Because managers want to avoid the bad signal and the high costs of convincing outsiders to invest, they follow this order. Step 1. Internal funds, retained earnings, * intuition. This is your own pocket money. Why? It's the cheapest and easiest. You don't have to ask anyone for permission, you don't have to reveal any secrets to a bank, and there are no issue costs, fees paid to investment bankers. Step 2. Debt intuition. If you run out of pocket money, you ask for a loan. Why? Debt is seen as a safer bet by investors because they are first in line to get paid. Because it's safer, it doesn't require the manager to reveal as much sensitive information, and it doesn't signal that the stock is overpriced. Step 3. Equity, the last resort. Intuition. This is like selling a piece of your house to a stranger. Why? It is the most expensive and sends the most desperate signal. Companies generally only issue equity when they have no cash left, and their debt levels are so high that banks refuse to lend them more. 3. Comparing the theories. To truly understand pecking order, it helps to see how it differs from the trade-off theory you just learned. Feature: Trade-off theory, pecking order theory. Main goal: find the optimal debt ratio. Use the easiest source first. Why use debt? To get the interest tax shield. Because you ran out of internal cash. View on profit. Profitable firms should have more debt, more tax to shield. Profitable firms have less debt, they have enough cash to fund themselves. Analogy: a chef balancing ingredients for the perfect recipe. A teenager spending their allowance, then asking parents, then selling their bike. Real-world example: Apple or Google. Think about high-cash companies like Apple. According to the trade-off theory, they should have massive amounts of debt to take advantage of tax shields. However, for years they held hundreds of billions in cash and had very little debt. This is the pecking order in action. They were so profitable that they never reached the debt or equity stages of the hierarchy.